Have you ever had a moment where you finally see the truth about yourself? A moment where everything becomes painfully clear? That's what happens to many traders when they finally review their results honestly. Picture this. It's late at night. You're sitting in front of your computer, staring at your trading account. You've been trading for months, maybe years. You have a strategy. You've tested it. The numbers say it should work. Your backtests show a clear edge. But your real account tells a different story. You're not profitable. You might even be losing money. And deep down, you know exactly why. But you've been avoiding looking at it directly. Tonight is different, though. Tonight, you're not placing trades. Tonight, you're doing something you've avoided for too long. You're reviewing every single trade from the past few months, every single one. And what you're discovering is hard to accept. When you separate your trades into two categories, the truth becomes undeniable. Category 1, trades that followed your strategy exactly. Category 2, trades where you made adjustments, improvements, or creative interpretations. And here's what the numbers show. The pure strategy trades are profitable. The adjusted trades? Massive losers. You increased your position size on setups that looked extra strong. You entered trades early to catch more of the move. You held trades longer to maximize profits. You added to winning positions to compound your gains faster. Every single adjustment seemed smart in the moment. Every change felt like you were improving your strategy, showing market intelligence, using your experience. But every single adjustment cost you money. The desire to make more money faster, the belief that you could outsmart your own tested system, that's what destroyed your results. This is the moment you realize your real problem. Your strategy isn't broken. Your discipline isn't even the main issue. Your problem is greed. And once you see it clearly, everything changes. Let me tell you about a trader named Yale who went through exactly this realization. This realization hits differently for every trader, but the underlying psychology is universal. Let me introduce you to Yale, whose story perfectly illustrates how greed takes over even when you know better. Yale had been trading for 2 years when he finally sat down and reviewed his 247 trades. Out of those, only 89 followed his strategy exactly, just 36%. The other 158, what he now calls greed trades. The 89 pure strategy trades, profitable overall, with a 12% return. The 158 greed trades, they lost 34%. Seeing the numbers laid out like that was Yale's wake-up call. But it raised a bigger question. Why does greed take over, even when you know better? Greed in trading isn't about being a bad person. Greed is actually a normal human emotion. Your brain is wired to want more. When something good is happening, your brain wants it to happen faster, bigger, better. This worked great for our ancestors. If they found a bush with berries, the greedy ones who took as many berries as possible survived better than the ones who just took a few. If they saw an opportunity to hunt, the greedy ones who pushed for more meat fed their families better. But in trading, this same instinct destroys you. Because trading isn't like picking berries. In trading, trying to get more often means you get less. Trying to go faster often means you go backward. Yale's greed showed up in very specific ways. When he had a winning trade making $100, his brain would whisper, "This is good, but what if you doubled your position size? You could make $200 instead." When his strategy said to enter at a certain price, his brain would say, "Why wait? Enter now, and you'll catch more of the move." These thoughts felt logical in the moment. They felt like smart improvements to his strategy. But they weren't. They were greed disguised as intelligence. The tricky part about greed is that sometimes it works. Sometimes Yale would double his position size and make more money. Sometimes he would enter early and catch a bigger move. And those occasional wins, they reinforced the behavior. This is what psychologists call intermittent reinforcement. It's the same principle that makes gambling addictive. You don't win every time, but you win often enough that your brain thinks it's a good idea to keep trying. Yale's brain remembered the one time doubling his position made him $400 in a day. But it conveniently forgot the 5 times doubling his position lost him $200 each. The net result was negative, but the emotional memory was positive. What made Yale's situation even more frustrating was that he genuinely believed he was improving his strategy, not destroying it. Yale wasn't just randomly making trades. He had reasons for every adjustment, good reasons, or at least reasons that sounded good in his head. When his strategy said to risk 1% per trade, Yale would think, "But this setup is especially strong. The trend is clear. All the indicators are aligned. This is basically a sure thing. It makes sense to risk 2% or even 3% on this one." When his strategy said to wait for a specific entry signal, Yale would think, "But the move is starting right now. If I wait for my signal, I'll miss the best part of the entry. It's smarter to get in early and maximize my profit." When his strategy said to exit at a certain profit target, Yale would think, "But look at this momentum. The price is flying. Why would I close this now? I should let it run and make even more money." Every single thought felt like improvement. Every adjustment felt like smart trading. Yale wasn't being reckless. He was being strategic. Or so he thought. This illusion is what makes greed so dangerous in trading. If greed felt like greed, you could fight it. If you knew you were being greedy, you could stop yourself. But greed doesn't feel like greed. Greed feels like opportunity. Greed feels like intelligence. Greed feels like you're finally figuring out how to trade better. Yale spent months convinced that he was evolving as a trader. He thought his adjustments were signs of experience and market understanding. He thought he was learning to read the market better than his mechanical strategy could. The truth was the opposite. Every adjustment was moving him further from profitability. Every improvement was making his results worse. But because some adjustments worked sometimes, Yale never connected the dots. It took that painful night of reviewing all 247 trades to see the pattern. The strategy worked. The adjustments didn't. It was that simple and that brutal. This realization forced Yale to completely rethink what having a trading edge actually means. Most traders, including Yale, think about edge the wrong way. They think an edge means you win more often than you lose. Or they think an edge means you make more money per winning trade than you lose per losing trade. But that's not really what an edge is. An edge is a statistical advantage that plays out over many trades. An edge is something that works not because it's right every time, but because it's right enough times, in the right way, that you make money overall. Think about a casino. The casino has an edge in roulette, but the casino doesn't win every single spin. Players win all the time. Players have winning nights. Players even have winning months. But over thousands and thousands of spins, the casino's edge plays out. The math works. The casino makes money. Trading is the same. Your strategy doesn't need to win every trade. It doesn't even need to win most trades. It just needs to win enough
with the right risk-reward ratio that over many trades, you come out ahead. Yale's strategy had a 58% win rate with an average risk-reward of 1 to 1.5. That means he won 58 out of every 100 trades, and when he won, he made 1.5 times what he risked. When he lost 1 unit. The math is simple. 58 wins times 1.5 units equals 87 units gained. 42 losses times 1 unit equals 42 units lost. Net profit, 45 units per 100 trades. That's a solid edge. That's a strategy that makes money. But the edge only works if you trade it exactly as tested. Every time you adjust it, you're potentially destroying the edge. When Yale increased his position size on strong setups, he was gambling that he could identify which setups were stronger than others. But his strategy's edge didn't come from identifying strong setups. It came from taking all the setups and letting the math play out. When Yale entered early to catch more of the move, he was changing his entry point. But his strategy's edge was based on a specific entry point. Changing the entry changed the win rate, and changing the win rate destroyed the edge. When Yale held trades longer to maximize profits, he was changing his exit point. But his strategy's edge was based on a specific exit point that balanced capturing profit with avoiding reversals. Holding longer meant getting caught in more reversals, which destroyed the edge. Every adjustment Yale made seemed small, but small adjustments to a trading system can completely change its performance. It's like baking a cake. The recipe says 2 cups of flour. If you think, I'll add 3 cups to make it better, you don't get a better cake. You get a completely different thing that probably doesn't taste good.
Understanding all this intellectually was one thing, but actually changing his behavior was another challenge entirely. Yale made a decision. For the next 100 trades, he would follow his strategy exactly. No adjustments, no improvements, no creative interpretations, just pure mechanical execution. He created a rule. If the strategy says take the trade, take it. If the strategy says close the trade, close it. No exceptions. No special circumstances. No, but this time is different. The first few trades were torture. Yale's strategy gave him an entry signal on a pair that looked weak to him. Everything in his experience screamed that this trade would lose. But his rule was clear. Follow the strategy. So he took the trade. The trade lost. Yale felt that familiar frustration. See, this is why I need to use my judgment. The strategy doesn't know what I know. But Yale stuck to his commitment. Next trade, the strategy gave a signal. Yale took it. This one won. Then the next one lost. Then 2 wins. Then a loss. After 20 trades, Yale was barely breaking even. He was frustrated. He was bored. The old Yale would have started making adjustments by now. The strategy isn't working. I need to fix it. But Yale remembered those 247 reviewed trades. He remembered that his adjustments had a 34% loss rate, while his pure strategy had a 12% gain rate. So he kept going. Around trade 30, something interesting happened. Yale stopped caring about individual trades. He stopped analyzing whether each trade looked good or bad to him. He just executed. Signal came, he took the trade. Exit came, he closed the trade. It was boring. It was mechanical. It felt like he wasn't even really trading. He felt like a robot just clicking buttons, but his account was growing, slowly but steadily. By trade 50, Yale was up 6%. Nothing exciting, nothing to post on social media, but up, consistently up. By trade 75, Yale had his first losing streak, 5 losses in a row. The old Yale would have panicked. He would have changed something, increased position size to recover, skipped the next few signals because the strategy isn't working right now. But the new Yale just kept executing. Loss number 6, then a win. Then 2 more losses, then 3 wins. The losing streak ended, and his account was still up 4%. By trade 100, Yale's account was up 11%, and here's what shocked him. His win rate was 56%, slightly lower than the backtest's 58%, but his average risk-reward was actually 1 to 1.6, slightly better than the backtest's 1 to 1.5. The edge was real,
The strategy worked, but it only worked when Yale let it work. Reaching that 100-trade milestone didn't just prove the strategy worked, it revealed something deeper about what was really holding Yale back. The hardest part for Yale wasn't following the strategy. The hardest part was giving up control, giving up the belief that he could do better than the strategy, giving up the ego boost of reading the market and making smart adjustments. Greed isn't just about wanting more money. Greed is also about wanting to be right, wanting to be the hero of your own story, wanting to prove that you're smart and talented and special. When Yale followed his strategy mechanically, he wasn't the hero. The strategy was. Yale was just the person clicking buttons, and his ego hated that. Every time a trade went well, Yale's ego wanted to take credit. I saw that this was a strong setup. I knew this would work. But Yale had to remind himself, the strategy identified this setup, not me. I just executed it. Every time a trade looked bad to him, but the strategy said to take it, Yale's ego wanted to override the strategy. I'm smarter than this mechanical system. I can see that this won't work. But Yale had to remind himself, my judgment has a 34% loss rate. The strategy has a 12% gain rate. Trust the strategy. This mental battle happened every single day. Some days, Yale wanted to quit. He wanted to go back to using his judgment and making adjustments. It felt more satisfying. It felt like real trading. But Yale had a trick that helped him. Every morning before trading, he would open his spreadsheet of those 247 reviewed trades. He would look at the column showing pure strategy trades, profitable. Then he would look at the column showing greed trades, massive losses. That visual reminder was powerful. It helped him reconnect with reality when his ego wanted to take over. Yale also started thinking differently about trading. He stopped seeing it as a game where he had to be smart and right. He started seeing it as a business where he just needed to execute a profitable system consistently. A McDonald's franchise doesn't succeed because the employees are creative and make improvements to the recipes. It succeeds because every burger is made exactly the same way every time. The system works. The job is to execute the system. Yale became a franchise operator of his own strategy. His job wasn't to be creative. His job was to execute the system perfectly every single time.
After several months of mechanical execution, something unexpected happened that confirmed everything Yale had learned. Yale was on trade 187 of his commitment to pure strategy execution. His strategy gave him an entry signal on the GBP-USD pair. But something was different this time. Yale looked at the setup, and everything in his experience told him this trade was going to be a massive winner. The trend was strong. The entry was at a perfect support level. The momentum was building. This looked like one of those trades that could run for 500 pips or more. This was the kind of trade that could make his whole month. Yale's strategy said to enter with his standard position size and exit at his standard profit target of 150 pips. But Yale's brain was screaming at him, "This is the trade. This is the one. Double your position size. Triple it. And don't take profit at 150 pips. Let this run to 500. This was the exact kind of situation where the old Yale would have made adjustments. This was where greed would take over, disguised as smart trading. But Yale had a rule. No adjustments, no exceptions. So he took the trade with his standard position size and set his exit at 150 pips. The trade moved in his favor immediately. Within 2 hours, Yale was up 50 pips. Within 4 hours, 100 pips. By the end of the day, his profit target of 150 pips was hit. The trade closed automatically. Yale felt good. Another win. Another successful execution of his strategy. He closed his platform and went about his evening. The next morning, Yale opened his charts out of curiosity. He wanted to see what happened to that GBP-USD pair overnight. And what he saw made his heart sink. The price
had reversed completely. Overnight, the GBP/USD had crashed. If Yale had still been in that trade, if he had held it like his greed wanted him to, he would have watched his 150 pip profit turn into a 200 pip loss. But because he followed his strategy, because he took his profit at the planned exit, he locked in his win before the reversal happened. This wasn't the lesson Yale expected. He expected the lesson to be, see, the strategy works even when trades look bad. But this lesson was different. The strategy protects you even when trades look amazing. Yale realized that his strategy wasn't just about capturing wins. It was also about protecting him from the inevitable reversals and traps that happen in the market. His greed would have kept him in that trade right into the reversal. His strategy got him out at the perfect time. This single experience changed how Yale viewed his strategy. He stopped seeing it as a constraint. He started seeing it as protection. Protection from his own greed. Protection from his own ego. Protection from the market's ability to reverse at any moment. That breakthrough moment wasn't just emotionally significant. It marked the beginning of Yale's most consistent trading period ever. After 1 year of pure mechanical execution, Yale's results were remarkable. Not because he made 500% or became a millionaire, but because he was consistently profitable month after month. His account grew 47% over that year. Some months he made 8%. Some months he made 2%. 1 month he actually lost 3%. But overall, the edge played out. The math worked. The strategy delivered what it was designed to deliver. More importantly, Yale's relationship with trading completely changed. He was no longer stressed. He no longer stayed up late second-guessing his trades. He no longer felt that constant anxiety about whether he was doing the right thing. Trading became boring in the best possible way. Wake up, check for signals, execute signals, close the platform, live his life. Yale's friends who traded noticed the change. They would ask him, "How's trading going? What's your win rate this week? What setups are you watching?" Yale would answer, "I don't know my win rate this week. I'm just executing my strategy. Some trades win, some lose. Over time, it works out." His friends thought he was being secretive or evasive. But Yale genuinely didn't obsess over individual trades or short-term results anymore. He had learned that obsessing over each trade was what fed his greed. Not obsessing was what let his edge work. Yale also noticed something interesting about his losing trades. They didn't bother him anymore. When a trade lost, Yale would just think, "That's expected. My strategy wins 58% of the time, which means it loses 42% of the time. This is one of the 42%. No frustration, no desire to recover the loss with a bigger trade, no questioning whether the strategy still worked. Just acceptance that losses are part of the process. This mental shift was the real breakthrough, because once Yale stopped fighting his strategy and started trusting it, the strategy could finally do what it was designed to do: make money over time through statistical edge.
Looking back over his entire journey, Yale identified several key insights about greed that every trader needs to understand. First, greed isn't always obvious. It doesn't always feel like greed. Most of the time, it feels like intelligence, opportunity, or smart trading. You have to learn to recognize greed even when it's disguised. Second, greed isn't a one-time problem you solve. It's a constant temptation that shows up in different ways. You have to build systems and rules to protect yourself from it continuously. Third, the best way to fight greed isn't willpower. It's a commitment to a system. When you have a rule that says no adjustments, no exceptions, you don't have to make a decision in the moment. The decision was already made. Fourth, trusting your strategy means accepting that you won't maximize every single trade. Some trades could have made more if you held longer or risked more, but chasing maximum profit on each trade destroys your edge overall. Fifth, consistency beats optimization. A decent strategy executed perfectly beats a perfect strategy executed inconsistently. Yale's strategy wasn't the best possible strategy, but executed consistently, it made steady money. Sixth, your ego is not your friend in trading. Your ego wants you to be the hero. Your ego wants credit for wins. Your ego wants to prove it's smarter than a mechanical system. But your ego will cost you money. Seventh, boring is profitable. Exciting trading is usually losing trading. If trading feels exciting, you're probably doing something wrong. Profitable trading feels boring and mechanical. Eighth, protection is as important as profit. A good strategy doesn't just help you make money on good trades, it protects you from bad trades and unexpected reversals. Trust the exits as much as you trust the entries. These lessons didn't come from reading books or watching videos. They came from Yale's painful experience of losing money for 2 years before finally letting his edge work. Yale's transformation from greedy trader to mechanical executor offers a clear path for anyone struggling with the same issues. If you have a strategy that you've tested and you know has an edge, but your results don't match the backtest, the problem is probably the same as Yale's problem. You're making adjustments. You're letting greed interfere with your edge. Here's what you can do starting today. Review your last 100 trades honestly. Separate them into 2 categories: trades that followed your strategy exactly and trades where you made adjustments. Calculate the results for each category separately. You'll probably find that the pure strategy trades are profitable while the adjustment trades are not. Make a commitment to execute your strategy mechanically for the next 50 trades. No adjustments, no improvements, no special circumstances, just pure execution. Create a rule. If the strategy says take the trade, take the trade. If the strategy says close the trade, close the trade. Write this rule down and put it where you can see it every time you trade. Before each trading session, remind yourself why you're following this strategy. Look at your backtest results. Look at your review of past trades. Reconnect with the evidence that the strategy works when you let it work. When greed whispers that you should make an adjustment, recognize it for what it is. It's not intelligence. It's not opportunity. It's greed. And greed disguised as intelligence has cost you money before. Accept that some trades will look bad but will win. Some trades will look amazing but will lose. Your job isn't to judge each trade. Your job is to execute the system and let the math play out over many trades. Embrace boring. If trading starts feeling exciting, that's a warning sign. Exciting means emotional. Emotional means you're probably about to make a mistake. Boring means mechanical. Mechanical means profitable. Trust your exits as much as you trust your entries. When your strategy says close the trade, close the trade. Don't hold for more profit. Don't try to squeeze extra pips. The exit is designed to protect you as much as the entry is designed to profit you. Track your execution percentage. Don't just track wins and losses. Track how often you execute your strategy exactly as designed. Your goal is 100% execution. Perfect execution of a decent strategy beats imperfect execution of a perfect strategy. Yale's journey from losing trader to consistently profitable trader wasn't about finding a better strategy. It wasn't about learning more about the market. It wasn't about developing better market intuition. It was about getting out of his own way. It was about letting his edge work instead of interfering with it. It was about recognizing that greed, disguised as intelligence, was his real enemy. You probably have a strategy that works. You probably have an edge. The question isn't whether your strategy is good enough. The question is whether you're letting it work. Are you making adjustments based on how setups look to you? Are you increasing position size on strong trades? Are you entering early to catch more of the move? Are you holding trades longer to maximize profit? Those adjustments feel like improvements.
They feel like smart trading, but they're probably destroying your edge. The path forward is simple but not easy. Commit to mechanical execution. Follow your strategy exactly. No adjustments, no improvements, no creativity. Let your edge work. Trust the process. Accept boring. Embrace consistency. That's how Yale finally became profitable. That's how you can become profitable too. The strategy was never the problem. Your interference with the strategy was the problem. Stop interfering. Let your edge work.